Hey guys, this is the Max Invest channel, and today we're going to be taking a look at DraftKings stock. If you enjoy the video, please remember to like and subscribe, and remember this is for entertainment purposes only, and nothing is financial advice on this channel. Before we get into the specific stock, I want to take a look at the market opportunity that these gambling stocks will have going into the future. To help ease the economic impact of the pandemic, US lawmakers are already pushing to legalize online sports betting. This is to increase tax revenue and help deal with the economic impacts that we have seen last year. Cuomo has already stated that he is going to be doing this for this specific reason. Currently, sports betting is legal in only roughly 20 states. However, 20 more states are highly likely to legalize, such as Washington and South Dakota. 11 are, however, yet to make plans, but this is half the amount that are already making plans. Google is placing gambling apps on its Google Play Store, which shows that Google believe that this sector will grow and they believe they can get revenue from this. And fantasy sports is expected to grow at a compounded annual growth rate of 13% from 2021 to 2027, showing that this sector should begin to get bigger and bigger. iGaming is another part of this sector that is growing rapidly, which basically means any online gambling games such as blackjack or roulette, and this is expected to continue growing into the future rapidly and is something DraftKings do just like fantasy sports. Let's take a look at what DraftKings stock is more specifically. DraftKings is an American sports betting company founded in 2012 by Jason Robbins and a few other people. Jason Robbins is the CEO to this date. It went public in April 2020 via a SPAC merger. It has signed exclusive sports deals with Canada, showing that it's more than just an American company and is going global. It has a $24 billion market cap, and it's not a penny stock. It is a pretty big company. There is DraftKings Fantasy Sports, and this refers to anything to do with individuals competing with other people based on fantasy sports teams and things. DraftKings actually offer daily competitions for this, whereas most companies make it a yearly or a weekly competition, which means you get paid quicker with DraftKings. DraftKings have Sportsbook, which is just your regular sports betting, and they have iGaming, which I've already stated what that is. They are headquartered in Boston, Massachusetts, and will be releasing fourth quarter earnings on February the 26th, and they could have a bit of a run-up for this, especially because they think they're going to do very well. They're a vertically integrated company, and they like doing everything themselves, which I love about a company. We should also check to see if DraftKings are financially sound. In 2020 quarter three, DraftKings had $133 million of revenue, which represents 98% year-over-year growth. This shows they're really getting into that exponential growth stage, and that is crazy growth for any company. DraftKings, however, have quite a high cost of revenue, and they are currently not profitable. They're reinvesting a lot into the business, spending a lot on marketing, and they're just not a profitable company. They're running at a net loss of a significant amount. DraftKings also have negative adjusted EBITDA and negative free cash flows, showing that they are quite far from profitability right now, and they're expected to achieve this by roughly 2025. DraftKings also have quite a superb balance sheet. They have a current ratio of 2.9. This means DraftKings have 2.9 times the total current assets as total current liabilities. I love looking at the current ratios of certain companies as it means they can easily make current debt payments and they have a lot of cash on hands. DraftKings has the ability to do this with a massive current ratio of nearly 3. Generally, I look for above 1, and this is blowing that out of the park. DraftKings have also been debt-free for 5 years, which is a great thing and means they probably won't go bankrupt. Even their long-term assets completely dwarf their long-term liabilities, with over $1 billion in long-term assets and $59 million in long-term liabilities, showing they have a pretty good balance sheet going into the future. DraftKings have also recorded an insane growth rate. Simply Wall Street predicts that DraftKings will be profitable by 2025. They are expected to have $2.81 billion in revenue by 2025 and 64 million in earnings by 2025. Currently, their earnings is something like negative 700 million, something around there, and it is very negative. So simply Wall Street believe that this will actually be positive by then, and they'll be turning over a profit. DraftKings has recently become the number one iGaming brand in multiple states that allow iGaming. DraftKings have had that 98% year over year growth that I've already said, and they've managed to raise $1 billion in capital for future growth. As you can see on the screen, DraftKings have been growing at a 31% compound annual growth rate. DraftKings predicted originally that by 2021 they would have 700 million in revenue. However, they have done so well this year that they've actually revised those aims. As we can see, DraftKings have revised those aims from 750 million to 850 million, which equates to a 45% year over year growth. This is insane for any company, and I can't believe that DraftKings think they've done that well this year that they can continue to do better. The analysts also seem to agree with DraftKings, and they think DraftKings are acting on the conservative side. The average estimate for DraftKings growth rate from 26 analysts is 866 million. The low estimate is 800 million, which is still amazing, and the high estimate is 1.23 billion. This shows the analysts have very high faith in DraftKings, and it really does look like it has some great growth ahead of it. It is also important to check out the competitive advantages for DraftKings, as it's in a highly competitive industry and it needs to be able to compete well with the competition. DraftKings does have numerous competitive advantages. Its first one is it is already the biggest next generation gambling company. It has a market cap of 24 billion compared to companies like Skills with a market cap of 16 billion and Golden Nugget Online Gaming with a market cap of 1.2 billion. This already means DraftKings is likely best positioned to capitalize on this growing industry, and it has already had the growth to back up this. Another competitive advantage is that DraftKings does so much. They do sports betting from a massive range of sports, they do fantasy sports, and they do iGaming. This is more than most of the gambling companies. DraftKings already have some massive deals that put it ahead of the competition. DraftKings have already taken in Michael Jordan as their special advisor. They have big deals with the New York Giants, big deals with the Chicago Bulls, big deals with the UFC, and big deals with numerous other sports. This is different to a lot of the competition who simply are not well established enough to have these big deals. DraftKings is vertically integrated, as we have already said, and they have an ambitious team that aim to make DraftKings the gambling company of the future. Another good thing to point out about DraftKings is Cathie Woods recently bought the stock. This means you know there's big things in store for DraftKings, as Cathie Woods likes to buy the disruptive next generation stocks that will do amazing in the future and has a track record to prove that this has worked. This could be potentially because DraftKings has a massive range of features and is vertically integrated, making it likely to disrupt the online gambling sector. It's also important to take a look at the management team to see if they're managing the company well. Since 2012, the management team has not changed very much. It was founded by Jason Robbins, Paul Lieberman, and Matt Kalish. Jason Robbins is the CEO of the company to this day. He owns 1.33% of DraftKings stock, being the majority of his net worth. He holds over $300 million of DraftKings stock, yet has sold $70 million. I don't think that this is a big red flag that he has sold DraftKings stock recently. As the company has made him so much money, it does make sense to do some profit taking and have some of that money, yet keep most of it in the stock to accumulate over time. One thing that I love about the management team is that they are a highly ambitious management team. To quote, "It's our ultimate vision to build the best, most trusted, and most customer-centric destination for skin in the game fans. DraftKings want to do a lot. They want to be a completely vertically integrated company doing everything themselves, which they basically already are. The management team love this company and are highly ambitious about it. However, I believe DraftKings is a highly risky stock. The main reason for this is the valuation on the company right now, which I will get into later. Another reason for this is DraftKings is highly reliant on the third party, such as the NFL and other things, coming out and making deals with them. If these deals go away, or if another company gets these deals instead, it could be detrimental to DraftKings stock. DraftKings also plays in a highly competitive space. It is competing with legacy casinos when it's doing its iGaming and all that type of stuff to see if people go online or go to the actual casino. It's also competing with a whole bunch of other online gambling stocks such as Penn, Skills, and Golden Nugget Online Gaming. If it cannot beat the competition, the stock will not do well. Let's take a look at the price targets for DraftKings. Remember, none of this is financial advice. I personally believe DraftKings is overvalued. It's recently gotten above $60 off the back of Cathie Wood's buying in, meaning it has a market cap of $24 billion. $24 billion market cap for a company predicting to earn $800 million next year with a price to book ratio of 10, and that is currently unprofitable and not expecting to be profitable until 2025, which may not even happen. $60 is way too high for this company. As you can see, the analysts have considered it a buy on average. However, in my personal opinion, I'm not going to be buying in at these levels. It may continue to go up, it may run away from me, and if that happens, I'll probably never buy the stock. However, this is my personal opinion, I could be wrong, and we'll see what happens. If you enjoyed the video, remember to like and subscribe, and click on this video right here. I'll be doing more deep dives and more market updates into the future. Also, if you disagree with anything or if you have any feedback for me, please write it down in the comments section. Thanks for watching.